How should one decide what to do with cash savings? It's a general principle that all cash should be used to provide a financial benefit or increase financial security. People who have saved some cash have different options. Some people act emotionally and others act logically. Each have their own reasons, and in some cases, they're both correct. Many people first think of investing cash to earn some income or in shares, hoping to grow the value of their cash. Other people prefer to enjoy the cash by going on holiday or buying things that they would like to have. Those people assume that they will earn more cash in the future, so why not enjoy the benefits of your hard work now? This makes perfect sense in many cases. There's a logical, step-by-step way of deciding the best way to use your cash. Once you know these steps, you would be in a better position to make your choice. You are the only one who can decide. We'd just like to make sure you know some of the options. What does one do with excess cash? Here, we focus on cash-like, safer, more liquid assets with lower risks and deliberately exclude shares that are more risky. We are going to look at repaying debts, saving for emergencies or retirement, saving for a project, investing in self-education or in a savings account, investing in short-term government bonds, investing in money market funds or ETFs, investing in a money market term deposit, and investing in a different currency. The first option to look at is repaying debt. Repaying debt is considered by many as the best use of excess cash. It's logical to start repaying the debt with the highest interest rate. These are usually credit card debts. If your loans or mortgage do not allow you to repay early, you have to consider if there's any way in which you can change them to make them more flexible. Sometimes this could be impossible, difficult, or costly. When you take out a loan, it's good to ask for the flexibility to repay early as long as it's not expensive to do so. Let's look at an example. If someone has a $10,000 credit card debt at 15% APR, that means annual percentage rate, he or she would need to pay $1,500 in interest a year. If that person has saved $5,000 in cash and decides to repay half the credit card debt, it would create a saving of $750 a year. If instead the $5,000 was invested in a deposit account with 3% APR, the person would receive $150 a year. The difference between repaying debt and investing the cash in this case would be $600. That's $750 minus $150. Do not hesitate to make the calculations. It's not difficult and can save you a lot of money. The second option to look at is saving for emergencies. It's considered a good idea to build a cash reserve. This is often called a reserve fund and is used for emergencies or in case you lose your job. This is supposed to cover 6 to 12 months of living expenses whilst you're looking for a job, for example. The cash should be invested in an account that pays some interest and it's easy to withdraw money from. Is it better to repay expensive loans or put money in a reserve fund? The following points may help you decide. A. If you lose your job, you still need to repay your debt. Do you want to use your reserve fund to repay debt or not? When you repay debt, your credit score improves. This increases your ability to borrow money with lower interest. When you have less debt, you spend less money on your debt, so you can save more. The above suggests that it may be economically better to repay debt before building a reserve fund. Option 3 is saving for retirement. Once all expensive debt is paid off and there's some money in the reserve fund, excess cash can be used to build a retirement fund. As the retirement fund would only be liquidated at the retirement age, cash in the retirement fund can be invested in different assets like shares with a longer term view. There are many rules of thumb on how much money one should have for retirement. One rule states that on retirement one should have 25 times one's annual costs. It is possible to argue for or against this rule. Please do your own small research to discover the alternative rules for retirement. You will find lots of different opinions on the internet. Some people, especially those at the start of their careers, may prefer to first save for a project before saving for retirement. Some examples are discussed next. The choice between a retirement fund and a project fund is a matter of personal priority. Number 4 is saving for a project. A project fund could be for renovating your house or buying a new house, setting up a business in a few years, paying for your children's education, helping your children buy a house, paying for the wedding of children, paying for a medical operation or cosmetic surgery, paying for the holiday of a lifetime, buying the car you always wanted, making a charitable or environmental donation. Different people have different priorities and different missions in life. In number 5, we have investing in self-education. Some of the most successful investors in the world believe that the more you know, the more you will earn. Younger people in the early stages of their careers can use excess cash to invest in self-education. The additional qualification may increase their employment prospects and salary. Professionals in later stages of their careers could also benefit from self-education, especially if they're keen to get a particular promotion or change the direction of their careers. Investing in self-education is investing in your future. It can motivate and energize, but needs good planning. Please research the course you want to do very well and have a plan for how you will use what you learn to get a better job. Number 6 is investing in a savings account. A savings account typically pays a relatively small rate of interest, limits the number of withdrawals per month, limits the total amount of withdrawal per month, can be more difficult or costly to make a large withdrawal. Some accounts can offer a slightly higher interest but with stricter requirements, and the interest you earn is usually taxable. Number 7, we have investing in short-term government bonds. Short-term government bonds are bonds which are close to expiry. These could be bonds issued some time ago that will mature soon, or more recently issued bonds with a short maturity. Their main characteristics are that they're usually safe because they're issued by the government. If the bond's held until maturity, you know the exact interest you will receive on your principal. You need to pay a trading fee to buy the bond and a custody account fee up to maturity. When someone holds the bond until maturity, there is usually no additional trading commission when the principal and final interest payment are repaid. The interest paid is usually taxable. Continuing with number 7, which is investing in short-term government bonds. How does one find the bonds? You can ask your bank or use a financial website that can screen bonds. Finding bonds is much harder than finding stocks. There are some websites that provide bond screeners. Some services are free and others require subscription. Please spend some time trying different services to see which one you like best. It's usually good to be able to screen by currency, country, maturity, coupon, YTM, which stands for yield to maturity, and the rating. Once you've found the website you like, you can consider subscribing. Some banks and online brokers offer bond screeners as part of their online or mobile banking offering. These are excellent. Yahoo Finance, Interactive Brokers, FINRA, which is Financial Industry Regulatory Authority, Markets Insider, Market Watch, Bloomberg, TradingView, Morningstar, S&P Capital IQ, BondDesk, Market Screener, Public.com, Börse Frankfurt, Euronext, Xetra, which is owned by Deutsche Börse, LSE, that's London Stock Exchange, Financial Times Market Data, Berenberg Bank, FactSet, TradeWeb, SIX, Swiss Exchange, and Swissquote are some examples of organizations that can help you screen for bonds. Number 8 is investing in money market funds and ETFs. Money market funds or money market ETFs invest in a pool of short-term, low-risk securities such as government bonds, short-term bank or corporate bonds, and commercial paper. They provide a safe place to keep your money whilst earning an interest that's usually better than a savings account. They're usually very liquid, meaning that you can take your cash out very quickly. Internet searches with keywords like short-term cash, short-term bond, short-term government bond, municipal bond, money market ETF, investment-grade corporate bond can produce a list of interesting results. You can also ask an AI engine for a list of money market and short-term cash funds in your country. Always check the yield and TER, that's a total expense ratio, for the ETF. Yields may be close to short-term government bond yields, and TERs are often between 0.1% and 0.4%. Number 9 is investing in money market term deposits. A money market term deposit is a way of investing your cash for fixed periods of 1 week, 2 weeks, or anywhere from 1 to 12 months or longer, whilst earning a rate of interest close to government bonds of the same maturity or higher. Term deposits are offered by larger banks on the main international currencies. The interest is known from the start and will not be affected by market conditions. You will usually not be able to access your money until maturity. The smallest size of term deposit for private investors is typically around 5,000 euros to 10,000 euros equivalent. Common sizes are usually around 50,000 to 100,000 euro equivalent. At maturity, the principal and interest are credited to your account. Some banks allow you to automatically roll the deposit at maturity. You can choose if to compound the interest with the principal at roll or take it out. At maturity, the bank normally contacts you to ask if you wish to roll your deposit or invest in something else. Another alternative to a money market term deposit is a fiduciary term deposit. With a fiduciary term deposit, your bank invests your deposit with another bank, at home or abroad, in its name but on your behalf. Your bank acts as an intermediary and it pays all payments received from the other bank to you. Each bank tends to work with a small number of fiduciary banks in the same or other countries. Whilst your deposit is sitting at another bank, you are subject to the risk of the other bank. Fiduciary term deposits are usually only offered for large amounts. They are especially useful for foreign currencies. The reason is that a foreign bank is often more interested in accepting deposits in its own currency than your local bank. For this reason, it can offer a better rate of interest. There are also banks in large financial centers like Luxembourg, Singapore, and Hong Kong that specialize in offering attractive fiduciary deposit rates. It's very important to be aware of money market and fiduciary term deposits. Number 10. Investing in a different currency. Changing your cash into a currency that pays a higher interest rate can earn you more interest, but it comes with risks. Currency risk. If the currency depreciates against your home currency, your gains from the higher interest could be lost, or you could overall lose money unless you want to keep your money and interest in that country. You need to understand why a particular currency is paying a higher interest and if there's a risk of depreciation of that currency. Often, countries with high inflation pay higher interest on their currencies. These countries are riskier places to have your money. Foreign exchange risks. When you convert cash to a different currency, you pay foreign currency account fees, usually on a quarterly basis, and foreign exchange commission for each exchange of money to and back from that currency. When you're investing in a different currency, you have to keep an eye on inflation in that country. A higher interest rate is attractive, but if there's a high inflation rate in the country whose currency you're buying, the real value of your interest could be less than you think. This risk is lower for short-term investments. Remember that countries paying higher interest rate often have higher inflation and weaker economies and are less stable as currencies. Diversification. Having your money in more than one currency creates diversification, which theoretically sounds good. However, if you buy a weak currency that gets weaker against your home currency, you may lose substantial amounts of money. Always try to understand the economic situation of the country whose currency you want to invest in. So how does one pick the right currency? To pick the right currency, it's not enough to look at the interest rates. One needs to consider the rate of inflation in the country of that currency, understand its economy, and other risks involved. As a rule of thumb, it's considered best to focus only on the large economies without currency controls and ones that your bank can offer you a currency account in. It could cost you too much to have an account in the currencies of smaller economies, and you may pay high foreign exchange fees. Can the currency risk be eliminated? There is often no easy way of protecting against a major collapse of a currency. Under normal circumstances, one can exchange the cash to a foreign currency, invest for a fixed period, and agree in advance to sell that currency at the end of that period and buy back the home currency. Usually this does not work, because the rate at which the bank would agree to buy back the currency from you would usually eliminate the interest benefit compared to your currency. Investing in different currencies can be very risky, so please be careful. Knowing what to do with cash that you accumulate through your working career provides security around your wealth.